Matron, take them away.
Okay guys, I was asked a very simple question. What is the best time frame to look at charts? So I'm going to answer that right now. And I'm also going to show it on a chart that I've actually just entered the market on. The market I've entered on is USD JPY. The order's just gone in. It's currently sitting against me a little bit, but not much. Tied myself up a bit. Not called scruff for nothing, you know, boys and girls. Not called scruff for now. And I need me coffee, because we all know Scruffy likes his coffee. Winky's gone off to get a haircut, left me on my own, and, well, it hasn't ended well. So I'll have to go get me coffee in a minute. But let me talk to you about the best time frame. And just to put something into context before I come onto it. I have told the guys already in the squad what I'm doing, so you can check the timestamps. This has gone in. That's exactly what I'm going to be doing, why I'm doing it. What we're also doing at this moment in time, as you can see, the guys are, we're going to be doing a small challenge. Well, it's not a challenge, it's just a way of trading together. Above and beyond what we already do. We are going to be putting money into a small BlackBull account. And if you want to follow the journey, there's a link for BlackBull in the comments and below. We're going to put 200 quid into it each. And we're going to trade 5 assets only, just 5. And it's based on the 5-3-1 strategy that has been around forever. Now, what that is, it's 5 instruments. So it's the best 5. You only trade them. 3 basic strategies. Now that'll be a swing, a day, and a scalp. And difference is long term, medium term, short term is basically what that means. And you trade it once a day, or at the same time every day. So you either trade like a London session, New York session, or an evening session at the same time. And that's 5-3-1. So it's 5 instruments, 3 strategies, 1 time frame. So that's the general gist of it. Obviously it'll change, and the idea is the guys are on the same hymn sheet and they'll be able to talk about what they're doing at any given day. So where does this come into? Well, the time frame of choice, if I had 1 time frame and I couldn't pick anything else, would be this one, the hour chart. The 1 hour is the one thing that will always present itself very well. Now I'm going to target this into this yellow line here, which is a shade over 50 quid. Now if you saw the other video I did earlier on this morning, you will see that I've already been into market and I pulled 125 out of pound JPY. Again, if I pull up the Discord, I'll just switch that back on a second, guys. At least I will do in a second. Pull this down. If we go back to week ideas, you'll see above it is pound JPY. And that went in very early this morning because it's another one where I've told them what I'm doing before I do it. And then you've got your strength sheet, etc., etc., etc. All right. The reason why I'm showing that is because it's very easy to say I've said something and done something after the event. Those guys see it before the event. That makes trading a little bit harder because I've got all of their eyes on me at any one time. So when I speak, I need to be damn certain I know what I'm talking about. And what I'm talking about comes always from this particular chart. If I couldn't look at anything else and I only had this to work on, this is the chart that I would use. Now, what can we see within it? And why have I ended where I've ended? Well, it's quite simple, to be honest. First of all, let's get rid of all these blue lines, just so that we can tidy up. And I'll get rid of the green ones as well. These levels are my sort of entry exit levels. Where I look at the market, I see what it's up to, and as the price approaches into them, I'm either going to buy or sell at them. Now, I do have zones that I put in as well, which are called golden eye zones. They help gauge where the market is potentially going to push to. And then I use a couple of indicators for no other reason than to get a broad stroke of what's going on in the market. Indicators are exactly what they say they are. They're an indication of what may happen, not necessarily what will happen. Because you've got to remember, every single one of them is lagging. But if you put them in the form of a combination, you can get a big picture. Then you can look at multiple time frames and drill that big picture in. But there has to be a trade idea. And that trade idea has to come from somewhere that holds a bit of weight, that's slow enough to show you the big picture, but fast enough that it can be tradable. And that's the hour. So what am I looking at here? Well, essentially I'm looking at drives and sort of areas of attraction. So I've got all my key levels put into place. These are all swing failures and high time frame fibs, right? So I know exactly what it is that I'm looking at, where the compression points are, where the bounce points are. Next part, where has been a strong directional drive? Well, that's it. You can see it fell off the cliff. And now it's meandering. You could say that's a strong directional drive, but look, it's contained inside of all of this. So where did that drive start? Well, it probably started in and around here. We can see where the bottom is. And then the easiest thing is just to work out where it came from. So you find out where it ended and go backwards on itself. Fibonacci. Fibonacci will give you a mathematical equation and it'll show you exact points. Right, straight away we're here. So what we're going to do is I'm going to put some key levels in, which is there. And it came up and it found that 76 retracement of this. Put in the 61.8. Sure enough, it's respected that. Find the 50. Sure enough, it's respected that as well. So these become key elements that we're looking at. Now here, what I'm seeing, because I ended this on a lower time frame, is there's the 38 and this candle's broke it. So it's broke that structure point and it'll look for the next one, which happens to be here, which is in line with a key fib that I put in earlier on. And then it'll work its way to 23, which is there. Dead simple. So there's that chart completely mapped up and it's given me sort of an area that I can work to, which is here. Looking for, well, I should actually only be looking for 9 pips on this. Why 9 pips? Well, let me show you. If I pull this down, because I'm looking at a scalp, it's telling me to sell it. It's telling me the anchor is the hourly. My notes is it says 10 plus because it reckons it's going to have a good sell because it's selling right across the board. But the minimum target is 9 because it don't move as much as what you think it does. All right, so if it's got a minimum target of 9, in and around 10, it's probably about right. Now, so that bounce point is 11.5. So it's above the minimum and it's above the 10 that my sort of little formula works out. Right. So I'm happy with that. Everything's in place. Now what do I want? Well, what if I'm wrong? What can I work against? Well, I'm looking for swing and failures. Well, there's a swing point. If it comes to this, where would it next fail? Probably that red line up here, right? But certainly this. So I can stage now from here into this black line, and then from that black line, if it gets beyond there, I have to think about what I'm doing, because that means the price can come all the way to here, and if it fails at that point, it's going to come all the way up to here. That's a hell of a way to go. So really, the sensible thing, if I'm looking at two straight failure points, is somewhere in and around here. So that blue line is where I'll stage to. So I'll stage from here up to that blue line. If it gets beyond that blue line, I have to start thinking about getting out of this thing, because I could well be wrong. So what I'm going to do is I'm going to let it play out, because I need a coffee, boys and girls. I definitely need a coffee, you know. Jesus Christ. I mean, it's howling gale out there. I've got a roofer on top of the garage. So putting a new roof on the outbuildings. I wouldn't fancy being him today, because it's wild out there. But happy days, he's enjoying himself. And I've just heard Winky come in, so that means I can go in the kitchen and say, can I have a coffee, my love of my life? Because you know I love you, and I dote on you and everything. And she'll make it. But she'll make it for one reason. Because if I did it, there'd be mess everywhere, and then she'd kick off. And then you'd see me with black eye. That's no good, because Christmas is next week, and I want to have my Christmas dinner with like a full face. Because she's violent. Nah, she's not. She's brilliant. She's my best friend. She really is my best friend. Right, okay, enough of the rambling. What we're going to do is we're going to watch this, come down into here, grab some money, finish for the day, and back up something that I've just said to the guys. Catch you at the end. And that's it, guys. Done. Quick scalp, in, out, sorted. Can't get any better than that. So let's just carry on about this hourly chart, shall we? So, as I was saying at the start of this, what's the best time frame? Well, as we've just seen, that trade idea came completely from the hourly. Yes, I go one step up, I go one step down, have a look, see what's going on. But the whole idea pretty much came from that 1 hour. So when you're scalping, and I'd be interested in your thoughts on this actually. Do you really think you need to go to a minute chart? No, not really. In fact, well, if you go a bit higher into a daily, it's maybe a bit too long. But as long as you can see the candle moving around, what's the constant? It's the price. Because it's exactly the same on the hourly as it is on the minute. The difference between the two is the hourly doesn't flick from one to the other. You know, it's not jumping around, and it's not scaring you out of the trade. But a minute candle will, because every minute it'll go green, it'll go red, it'll red, 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 green, 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 red, red. But really it's hardly moved. Whereas the hourly, if it's showing you it's red and it's pushing down, it's constantly pushing down, it's not a good sign that you should just hold the trade to target. Just a thought. So in answer to the question, if I had one time frame and I can't look at anything else, it'll be the hourly. So the principle that I work to is this. It's high time frame levels. So it's dailies, 4 hours, weeklies, monthlies. Look at very high time frames for the swing failures. Look for biases, etc. on the hourly. And then just see if you got a confirmation on a 15 and a 5. It's not difficult, not really. And the simpler you keep these trades, the easier it'll become. Now, I'm asked about stops and things like this all the time. I think that's a video on its own. But what I'll leave you with is my thoughts on stops. Stops have one job, just one. Protect the account, that's it. So I don't pay any attention to stops, none whatsoever, not in the traditional sense. In the traditional sense, you go, oh, you put your tight stop in, it's a hard stop, and you're going 3 to 1. You've already set yourself up to fail, and unless it's absolutely working for you, you'll always fail. And I'll tell you why. Because the odds of it hitting your stop is 3 times greater than it is your target. And unless the trades are absolutely identical, same conditions, same product, same target, same stop, the play out over time never happens. Because you'll tinker with it, you'll get worried with it, and you'll be stopped out all the time, certainly with variable spreads. My principle is always the same, it's one-on-one. But it's one-on-one based from a certain point, because I break my trades and I know I get in early. So my one-on-one point is not necessarily my entry point. So if I know the stop is only there to protect the account, I can trade quite calm, because it goes in a place where I'm willing to pay for it. That's it. I'll look at where it should be. It needs to be around 2 structure points away, like 2 shields needs between me and the stop. And I'll measure the distance. I know roughly what my full position is, not my broken position, my full position. And I'll see whether or not I'm happy to pay that. Now, because of the account size I have now, and I trade relatively small in relation to it, I know I can afford it. So I'm happy to go into it, and then I'll stage up to it. A little bit like what I say in the videos. I'm looking at this swing point, I'll stage up to a certain point. Once it goes beyond that point, I'm in absolute damage control, and I need to look to ways to get out of the trade. That's why I break things up. But if it goes beyond a certain point, that decision's taken away from me, the hard stop will trigger, and it's game over. But I've already agreed to that price in the first place, so I'm not really worried. It's just a bad day in the office. And that's it. And I find that on the hourly as well. So as always, guys, very easy found. You find my contact details down in the comments. I do cherish your comments. Do hit them. I answer every single one myself. And as always, trade well, keep your risk managed, but above all, do what you love, and the money will follow. See you all in the next one.